Fisher French, let's talk some money, shall we? Not just the price of fuel, the price of our houses as well. People falling behind on their bond repayments. I'm not surprised, but just how bad is it?
You know, Gareth, we've seen some very, very concerning stats. The Old Mutual Savings and Investment Monitor, for example, found out that a third of home customers are struggling to make their monthly repayments. And then Standard Bank came out and they said that many of their customers are spending more than 40% of their income. This is just on meeting their mortgage repayments. We're not talking about all the other debts. And you know, you've just spoken about the fuel increase. People on a R1 million mortgage, Gareth, people are spending about 3,000 Rand more now than they were before the rate increases. Where are people supposed to find this extra money when salaries have only just gone up by inflation? So it's very real. This is a very real crunch. And many, many homeowners are literally saying, I don't know where to get the money to pay my mortgage.
Yeah, and the problem is you could get yourself into trouble when you start missing 1 month, 2 months, 3 months, and eventually the wolf comes start knocking at the door. We'll talk options in a second, Maya, or maybe you can build it into this next answer for me. How much should, if you were to take a combined household income, if we're talking about this 40%, spending over 40% of their income on meeting your mortgage repayments, how much should a combined income or one person's income in percentages go to paying off your bond? What's a responsible amount?
So the banks actually don't like to lend more than 30%. So this is well over the 30%. So in fact, most banks' kind of rule of thumb is 30% of your salary that they will consider for home loan repayments. It was quite interesting. I was looking at some numbers earlier this year, and many people were sitting at about, they were issuing it around 20%, probably because they knew that some of the rate increases were coming. So to be sitting at 40%, what I know from debt counselors is they say that once somebody is spending more than 40% of their salary on debt repayment, we're not just talking mortgages, we're talking total debt, they are now financially vulnerable. It is not sustainable. So this is very real, and many people are pushed over this. By the time they add their car finance in, those sorts of things, they're probably sitting closer to 50 to 60% of their salary going to debt at the moment.
So what do consumers start doing here? If we circle back to the house and the home loan and the mortgage, whatever we want to call it, what if you are one of those people watching now going, you know, I'm well above 40%. I'm not even able to put fuel in my car by the time I get to the end of the month, the last week, salty cracks week, I think some people call it as a joke. What do they do? Because you've signed a house bond. You can't just sell the house. It's not a rental. What are they supposed to do?
Yeah. I think the most important thing is to speak to your bank first, before you miss payments. Once you start missing payments, you're on the back foot. Then you're having a very different discussion. So I think go immediately to your bank. I must just say it's interesting, you know, Standard Bank came out and automatically, I think on 20,000 customers, they automatically pegged their installments and they didn't increase them in the last interest rate increase in May. So, you know, some of the banks have been quite proactive because they could see that the people were already sitting at 40% and couldn't absorb any more. So the banks are there to offer some form of relief. But Gareth, I want to remind everyone, we went through this in COVID, so I'm trying to remind everyone that any relief you get today results in extending the term of your loan, and it will cost you more. So if you have, you know, if you can still cut other expenses, you know, target and settle other debts that perhaps give you some cash flow towards the mortgage. That should always be your first step. You know, changing the term of your loan on your mortgage is not the first step. It's not the, don't think that's the easy step. That's the really tough step. And just to give you an example, if you had a R1 million home loan, and right now you're paying about 10,850 Rand a month on that. If you had to extend it from 20 years to 30 years, it would drop to 10,000 Rand repayment. So you'd have 800 Rand more a month. So that feels good. But the total interest over 30 years actually increases by R1 million. So your 800 Rand is costing effectively R1 million. So if you're going to do this and take the relief now, as soon as you have financial stability, as soon as those interest rates start to decrease, please make sure you have the discipline to pay an extra so that you're still paying it off over that 20-year period. See it as a very, very short-term solution and not something that you're going to stay with, you know, for the full period.
Yeah, absolutely. Short-term relief could have much bigger consequences down the road as well. Who knows, maybe in 5-10 years' time, you've taken the relief and now your situation's changed again. It might be even worse for you. Maya Fisher French, always good to speak to you. Appreciate the help this morning. So